In the unpredictable world of global finance, some predictions stand out for their sheer audacity and the shockwaves they send through the investment community. Every so often, a forecast emerges that challenges conventional wisdom and forces investors, analysts, and even central banks to rethink their strategies. One such forecast is HSBC's bold call that gold could soar to an astonishing $5,000 per ounce by the middle of 2026. This isn't just a headline-grabbing number, it's a projection that has the potential to reshape how we view the future of money, wealth preservation, and global economic stability. This isn't just a minor tweak to previous estimates. It's a signal of a potential paradigm shift in how we value the world's oldest and most trusted store of value. Gold has always been a safe haven in times of uncertainty, but a target like $5,000 suggests a level of concern and opportunity that goes far beyond the ordinary. Throughout history, gold has played a pivotal role during periods of crisis, from ancient empires to modern economies. Its allure has only grown stronger as financial systems become more complex and interconnected, making it a barometer for global confidence and fear. HSBC's forecast is grounded in deep analysis of converging global trends, not mere speculation. Their team has pored over data, examining everything from inflationary pressures and central bank policies to the shifting tides of international trade and the growing appetite for safe haven assets. With gold already trading near $4,427 per ounce as of January 8, 2026, the path to $5,000 no longer seems like a distant dream. Instead, it appears increasingly plausible, especially as investors seek shelter from mounting economic and political storms. This prediction is more than just a bet on gold's price. It's a stark warning about the fragility of our financial systems and a sign of eroding trust in paper currencies. As governments print more money and debts spiral, gold's appeal as a hedge against uncertainty grows ever stronger. The surge in gold is the result of years of accumulating risk, relentless quantitative easing, ballooning government deficits, and a world increasingly shaped by geopolitical instability. HSBC's $5,000 forecast is a wake-up call, a reminder that in times of turmoil, gold remains the ultimate safe haven. Geopolitical risk is a major driver behind HSBC's bullish gold forecast. From the South China Sea to Eastern Europe, global flashpoints threaten trade and financial stability. In such times, gold's role as a safe haven becomes critical. Its value isn't tied to any government's fortunes. The weaponization of finance, sanctions, tariffs, and exclusion from systems like SWIFT has pushed nations to diversify away from the US dollar. Central banks, especially in China and Russia, are stockpiling gold for strategic reasons, creating sustained demand. This de-dollarization is a structural shift, not a passing trend. Central bank buying removes gold from the market, tightening supply for private investors. Geopolitical maneuvering is now a powerful, enduring tailwind for gold's price. Beyond conflict, the global economy faces a deeper threat: soaring sovereign debt. Major economies have borrowed beyond reason, creating a fragile illusion of prosperity. Central banks are forced to keep rates low and print money, debasing currencies in the process. Gold's finite supply makes it the ultimate antidote to currency debasement. As people realize their money is losing value, demand for gold surges. The path of massive debt leads to inflation and eroded confidence in fiat currencies. This is why gold is being revalued, not just as a commodity, but as real money in a world drowning in debt. The journey to $5,000 gold won't be smooth. HSBC expects high volatility, with prices swinging between $3,950 and $5,050 in 2026. News, sentiment, and algorithmic trading will amplify price swings, shaking out even seasoned investors. Options and futures markets will add to the turbulence, as leverage magnifies both gains and losses. Short-term corrections are noise within a larger uptrend. For the patient investor, volatility is an opportunity, not a threat. Building a core position in physical gold and holding through turbulence is key. Volatility is the price of admission for participating in this historic wealth transfer. Gold's ascent won't be a straight line. Corrections are inevitable and healthy. Rapid price gains could trigger pullbacks, especially if geopolitical tensions ease or the Fed shifts policy. Temporary drops may spark panic selling, but the underlying issues, debt and currency debasement, remain. Even a hawkish Fed stance would likely be short-lived, as structural problems persist. For long-term investors, corrections are buying opportunities, not reasons to flee. The smart money uses these dips to accumulate more gold. As long as the core drivers remain, the path to $5,000 is intact. The U.S. Federal Reserve stands as the most influential force in global finance, shaping the direction of markets and economies around the world. Its decisions ripple far beyond American borders, affecting currencies, investments, and the very foundation of international trade. The policies set by the Fed have a direct and powerful impact on gold, making it a key player in the precious metals market. When the Fed acts, gold reacts, sometimes dramatically. Today, the Fed finds itself in a difficult position. If it raises interest rates to fight inflation, it risks triggering a fiscal crisis, increasing the cost of government debt, and potentially slowing the economy to a crawl. On the other hand, if the Fed chooses to print more money, it risks debasing the dollar, eroding its value, and undermining global confidence in the U.S. currency. In this environment, negative real interest rates, where inflation outpaces the returns on savings, have become the norm. This scenario is a powerful fuel for gold's ongoing bull market, as investors look for assets that can preserve their wealth. Savers and investors, seeing their cash lose value year after year, are increasingly seeking alternatives. Gold, with its centuries-old reputation as a store of value, becomes an attractive option in uncertain times. If inflation continues to rise and forces the Fed to tighten monetary policy, gold prices could face temporary setbacks, as higher rates make cash and bonds more appealing. Such tightening could cause gold to dip in the short term, as investors adjust to the new environment. However, any pain for gold is likely to be short-lived. Economic stress or market turmoil would likely force the Fed to quickly reverse course and return to easier monetary policy. This creates what many analysts call a ratchet effect. Each cycle of easing monetary policy pushes gold prices higher, while periods of tightening are brief and less impactful. Over time, this pattern means that gold's upward momentum is reinforced, with each new round of policy easing setting a higher floor for prices. Investors are keenly aware of the Fed's predicament. They see the central bank's limited options and are positioning themselves in gold before major policy shifts occur. As a result, more and more investors are moving their wealth into gold, seeking safety and stability as the future of the dollar looks increasingly uncertain. The growing realization that the Fed's only long-term solution may be to devalue the dollar is becoming a major psychological driver for the gold market. This shift in mindset is powerful. Investors are not just reacting to current events, but anticipating a future where gold plays an even more critical role in preserving wealth. All these factors are converging to propel gold toward HSBC's bold $5,000 forecast, as the world watches the Fed's every move and prepares for what comes next. A $5,000 gold price would signal a deep crisis in the global financial system, with ripple effects across all markets. The dollar's weakness would trigger inflation in the US and turmoil in currency markets worldwide. Countries holding dollar reserves would face massive losses, accelerating the move out of dollars and into gold. Stock and bond markets could crash as investors flee to safety. Gold miners and commodity producers would thrive, sparking a modern gold rush. This would mark a massive wealth transfer from holders of paper assets to owners of tangible ones. The global distribution of wealth and power would be fundamentally reshaped. The $5,000 gold forecast isn't about gold itself suddenly becoming more powerful or rare. Rather, it's a reflection of the changing value of the currencies we use every day. When we talk about gold's price rising, what we're really seeing is the purchasing power of fiat currencies, especially the US dollar, steadily eroding over time. This decline isn't accidental. It's the result of years of government policies, central bank interventions, and relentless money printing that have diluted the value of paper money. As more dollars are created, each one buys a little less, and gold's price in dollars appears to rise. Gold, on the other hand, is a constant. It doesn't change, it doesn't corrode, and it can't be printed at will. Throughout history, gold has maintained its value while currencies have come and gone, often destroyed by the very governments that issued them. Fiat money is based entirely on trust that governments will act responsibly and that central banks will protect the currency's value. But history is full of examples where this trust was broken, leading to the collapse of currencies through hyperinflation or mismanagement. Gold's limited supply and its independence from any government or institution make it the ultimate store of value. It doesn't rely on anyone's promise to pay, and it can't be defaulted on or devalued by decree. Today, we're witnessing the unraveling of the current fiat money experiment. Inflation is rising, trust in central banks is fading, and the price of gold is surging as a direct response to these pressures. As people lose confidence in paper money, they seek safety in gold. Investors, institutions, and even central banks are moving capital into gold to protect their wealth from the risks of currency devaluation. This isn't just speculation or a passing trend. It's a fundamental shift, where bad money is being driven out by good. Gold is reclaiming its role as the foundation of real value. The rising price of gold is more than just a number. It's a warning sign, a fever chart that reveals the underlying sickness in the global economy and the fragility of our current monetary system. Despite the compelling case for gold, prudence and diversification remain essential. Gold's role is to ensure against systemic risk, not to chase speculative gains. A strategic allocation, often 5 to 10% of a portfolio, can stabilize and protect wealth. Physical gold is best, as paper instruments carry counterparty risk. True insurance means holding the metal itself, securely stored outside the banking system. The $5,000 forecast is a warning, not a call to go all in. By preparing with a balanced, long-term position in gold, investors can weather the storm and preserve purchasing power for generations.